this is Eric Thompson. I am president, founder, and lead financial advisor of Peerless Wealth, a registered investment advisory headquartered right here in Columbus, Ohio. As always, thank you for tuning in. We are in the middle of March right now, and I thought it would be timely to talk a little bit about taxes. And hopefully you don't hit the stop button, because I know taxes can get boring. But what I'm going to do to make it interesting is I'm actually going to give you a couple of case studies of real clients. I'm not going to use their names, of course, of real clients that I've helped significantly save on taxes. And I think it will give you a better idea of, in general, of sort of the value I add to various situations, especially if you might have friends, family members that have complex financial and investment needs. Obviously, feel free to send them my way. And I'm going to start with a disclaimer here that I'm not a CPA, I'm not a tax advisor, I'm not an enrolled agent, but that doesn't mean I don't know a lot about taxes, and it doesn't mean I can't. It means I can't prepare your tax return, but it doesn't mean I can't help you cut your tax bill. So I'm going to give you a couple of examples of how I've done that recently with clients. The first case study is, I'm going to call this guy my young Donald Trump of Columbus. He's a very successful real estate investor, rentals, flips, Airbnbs. And he's a good friend of mine, and he's a great client and a great person. But anyway, he sold several properties last year. And if you buy a property at a certain value and sell it at a much higher value, you pay something called capital gains tax on that gain. And on properties, if you've been writing off depreciation over the years, you have to recapture that depreciation, and you have to pay income taxes on that too. So it was a good time for him to sell. He knew about the tax consequence, but it was a good enough offer to where he went ahead and pulled the trigger. And it was a seven-figure deal and a tax bill well into the six figures. And so his account with me, I practice something called tax loss harvesting. And I don't just do this for this client, I do it for any clients it's appropriate. And what that is we might own a dozen different investments in the account. We might own a large company stock fund, a small company stock fund, a bond fund, a real estate fund, et cetera, et cetera, et cetera. Well, 2022 was negative pretty much all the way around. So when things got pretty bad, what I did is I did a tax swap. So if we bought something for $100,000 and it was showing at $80,000, let's say it was a small cap index fund, I went ahead and pulled the trigger. I sold the small cap fund. And you might be thinking, well, Eric, are you selling low? Or are you selling at a bad time? Yes, but I'm immediately reinvesting the money, and I'm buying a slightly different small cap fund. So the portfolio is materially unchanged. You're not allowed to rebuy the same thing for 30 days, or they don't let you write their loss off. So I just buy something that's very, very similar. Well, I get to go ahead and book the loss for tax purposes for him. So I did that throughout the year, and he has a significant size account with me. And I talked to him at the end of last year, and we were doing a review on his account. He said, Eric, I set aside this money. I know I'm going to owe this in taxes from that building I sold in April. And I said to him, well, you know how much loss I generated for you. And I know that sounds bad. The account was down, but if we don't realize that loss, it'll rebound. It's already started. But if we don't realize that loss, we don't get any tax benefit from it. So I went ahead and realized losses as the bear market was happening in 2022, remain invested. And I was able to offset nearly all of his capital gain from his real estate from realized losses in his portfolio. And if we did nothing, things would have rebounded and we wouldn't have been able to write that loss off. So that sort of made his, it was around Christmas last year, and I believe we saved him over $200,000 in income tax. So that's case study number one. Case study number two is another client I'm in the process of working with on a specific structure. His family got an offer on the family farm, and it was a big offer. And I'm just going to use a figure of $10 million. Now, again, if they sold that farm, it's been a business, they would pay capital gains on the value of the land, because the value of the land was purchased 100 plus years ago. So the basis is basically zero. So between capital gains, state capital gains tax and federal capital gains tax, the family would owe something like $2.5 million on a $10 million sale. So that was an obstacle, obviously. So I talked to him about it. I said, I have a solution for you, or a potential solution. We can do something called a 1031 exchange, which is a real estate exchange. If you sell one property, you can buy a similar property, and you have to do it within I believe it's a 6-month period of time, and you don't trigger that tax. You defer it. You still have the original cost basis, but you don't trigger the tax until you sell the property that you roll the money into. And my client says, well, that's great from a tax standpoint, but Eric, I don't want to be a landlord. I'm getting ready to retire. That's not really what I want to do, and I don't have to with this much money. And I said, well, let me finish. What we're doing is we're 1031 exchanging it into a private real estate investment trust, which is a pooled fund. It's something like $8 billion worth of real estate. There's 80 properties there, everything from data centers to public storage units to apartment complexes to retail shopping centers. They're commercial real estate. And there's a separate entity, third party, that manages these. They have a 10-year plus track record of good returns. They pay a 4.5% dividend, and they've made almost double that in total return. Never had a down year. So we can, and we would not exchange the whole 10 million for diversification reasons. We might just do half of it. But we'd save taxes on $5 million. The other 5 might reinvest in other things for diversification and go ahead and pay the taxes. But that strategy would save my client $1.25 million in capital gains tax. And for those that know taxes might be thinking, well, yeah, but when he sells out of that private REIT, won't he then owe the taxes? Yes, but he doesn't have to sell it. And if he passes away and it goes to the heirs inherit it, and they have a new stepped up cost basis. All that gain is wiped out, and the heirs don't pay the taxes, and they start fresh. So this is a very unique situation, very specialized situation, but another example of significant tax dollars that can be saved by having a financial advisor that's experienced and can kind of think outside the box. And these are big things. There's a lot of smaller ways the everyday client can save on taxes. Small business owner, instead of just investing in a regular investment account, we can open up an IRA or something called a SEP IRA. And now all his contributions of that are tax deductible. And then there's a maximum you can do for that. But 401ks, if you have money to invest and you're not maxing out company 401k, you get a pre-tax deduction for that, not to mention probably a company match. So those are some simple and complex ways that I help my clients save taxes. So happy tax season. Thank you for tuning in, and we'll see you next time.